Hey, welcome to video number 3 in the series. In this video, I'm going to talk about why it's important to have some kind of strategy for what happens when you enter a trade. And I'm going to use the HODL example as why it's a bad idea to not have a plan for when you get into a trade. A lot of people in crypto do this thing, HODLing. I'm sure they do it in other asset classes as well. Which is just, I'm going to buy a thing, and if it goes down, I'm just going to hold it until it goes up. Or if it goes up, I'm just going to hold it until it gets to the moon, right? There's no real strategy there. All good traders will tell you when they get into a trade, they have some kind of target in mind. They have what they're going to do if the price goes up, what they're going to do if the price goes down. So what are the two things you can do? If you're, this is my drawing of a chart here. If you're buying here, what you can do is you can set a stop loss here. If the price goes down, you get out, right? Pretty straightforward. Another option is what's called averaging down, which what that means is if you buy here and the price goes down, you buy more. Maybe it goes down, you buy more here. I don't necessarily condone that. I think that what's happening there is you're sort of rewarding bad entries, and you should just be trying to buy here. But at least if you buy here, you could say, if the price goes down here, I'm going to buy more. And if it goes down here, I'm going to buy more, and then below that, after that, I'll just get a stop loss and I'll sell everything. So you can still have a strategy, and average down. You could even I don't know, if you want to risk $500, what would that be? $166 here, $166 here, $166 here. And you can still kind of manage how much you're risking in total, and use money management, use risk management, and still average down. Again, I think it's just a lot easier to just use a stop loss if you get stopped out, here, and then just wait until it gets down and then buy again. But whatever, at least that's a strategy. HODLing is buying here, and the price goes down, and you don't do anything. Now, it might be because you're like, oh, I think there's going to be, a support level here. I read something on Twitter and this guy says it's going to go up to the moon, whatever. People will make all kinds of excuses. But of course, that's just based on a belief. I believe the price is going to go up, right? And you might think that's how everybody trades. You trade because you have a belief of what's going to happen, but that's not necessarily true. You might believe something, but you have something set in case your belief isn't correct, right? You at least have some humility to think I'm not 100% right all the time. And this works both ways. HODLing can go, I'm just going to hold things until it gets to the moon. And that's why if you look back here, you have these boom and busts because this is when you held things and they went up like crazy, and this is when you held them and they just went down like crazy, right? There was no consistency to the whole thing. It was just, I believe the price is going to go down, or it's going to go up until here and down into here. There's no idea of exits. And that's the real big change you have to kind of make to your strategy. Your entries have much more to do with your trading system, what your signals are. It could be anything. It could be when, an RSI is oversold or a support level. I mean, you could say, I'm going to buy every time there's a full moon, whatever. It doesn't matter. The exits is much more to do with your risk management and your money management. And you kind of need these exits in place for money management to work, which I'll get to in a second. But again, all good traders know where they're going to get out if the price goes up, where they're going to get out if the price goes down. So, it could change. They could have their take profits here, and then the price starts to go up, and they say, you know what, I don't like the look of this market, I'm going to sell here. Same with the stop loss. It can get close to the stop loss, and they just say, no, you know what, I don't like it, I'm getting out. And that's fine too. That's obviously more based on instinct and experience. But at least there's an idea. You're saying, if I don't feel good about the market, I am going to get out. And hopefully you trust yourself. I think it's just better to have a hard stop and a hard take profit, because as you may have experienced, your emotions can really get the better of you during trading. So better kind of, I like to think of trading as there's a machine that trades, and I program the machine with information, and then the machine does the actual trading, right? Once it gets in, I don't touch it. I let the machine do its thing. It gives me some data. I won, I lost. Here's how much I won. And then I kind of use that information to retweak the machine. But whatever, if you want to use your instincts and your experience, great. But here's the important part. You need a way to test your system. You need a way to test your buys, your intuition, whatever it is, your system. So, for example, let's just say let's say that full moon method, right? It sounds retarded, but let's say you buy when there's a full moon. Let's say you bought and the price after the full moon went like this and then went down. Well, was the full moon method correct? I don't know, it went up, but then it crashed. Or if it did the opposite, if it went down and then it went up. Well, was it right? Well, yeah, it went up, but first it went down. So the reason exits are important is because you have to know if you were right or wrong, but you can only know right or wrong if you had some kind of goal in mind. Because you can't just say, I'm betting that the price is going to go up. Well, up to where? Up to 1,000,000%? Like, up to what? If you say, I think it's going to go up to here, and if it goes down, I'm going to get out here, you have hard data as, was I right or was I wrong? So then you can test that system and say, after 10 trades, I was right, 6 times and wrong 4 times. And therefore, it's a good system, right? You can't do that if you just HODL. Like, how do you know what makes your system work or makes it not work? If you're trading on intuition, is your intuition good or is it bad in the long run? Is the full moon system good or is it bad? You need to collect data. That's what all of this is about. All of money management is about collecting information so you can tweak your system, tweak your stop losses, tweak your take profits, and you can't tweak the numbers if you're not collecting the numbers. Of the two exits, the stop loss and the take profit, I think the stop loss is the more difficult one to start doing. If you tell people like, hey, if the price is going up, you should take profits here, they might be like, all right, whatever. Like, I like making money, so I'm not going to be that against it. But if you tell somebody to sell, people don't like taking losses. Like, if it feels wrong to take a loss. You feel like you did something wrong. But obviously, good traders get used to losses. They learn to accept the losses. This is why they say pro traders let their winners run and they cut their losers short, right? If they got in here and the price goes down, they cut it. The price goes down, they cut it. The price goes down, they do it 3, 4, 5 times, doesn't matter. They do it a bunch of times. They take losses all day. But when they win big, right? They say the opposite is true of amateurs. Amateurs will let their losers run and they'll cut their winners short. So obviously that doesn't make sense, but I've done it and I'm sure you've done it too, where you start making money, the price starts to go up, and then you start to worry, be like, shit, I don't want to lose this money, I'm in profit, I'm in the green, and you just sell. You sell because you get greedy. And then, as we talked about with the hodling, when you're losing, you start making excuses for why you think it's going to go up because you don't want to accept the loss, and then you end up, way down here. So if you tell somebody, hey, you should have sold here, somebody was hodling this all the way down, and you say, hey, you should have sold here, they'll probably say, yeah, of course, I should have sold there. But they didn't have the system in place to do that. The opposite is kind of true on the way up. If you tell somebody to take profits there, probably they're going to say, well, why? Because I could have made all this money, right? I mean, like, look at my bank account. It's doing great. But it is kind of rewarding bad behavior because it's not based on anything. You have no way of knowing, can you do it again? Is this a system based on any real solid statistics or numbers, or is it just you got lucky? I think it's like blackjack. Like, people who make a lot of money playing blackjack, they'll go to the casino and they think they're good at blackjack because they made a lot of money, and it's like, no, you were statistically one of the few people who got a lucky streak and made a lot of money. Like, that's, the house has an edge against you. Like, if it plays out long enough, you are going to lose your money. Unless you're counting cards, but that's something else. But people genuinely believe that they're good at, like, roulette, and it's like, no, that's not how numbers and statistics work. It's the same as people who made money while there was a bull market and they were just holding things while they went up. It's like, dude, you have no idea if you were lucky or not. And if you just establish some kind of system, maybe you could actually do this consistently. What really bugs me about it at the end of the day, and what I've found, is that this is all just based on beliefs and luck, like I was saying, and your job as a trader is to get rid of luck and to be in control of what happens. And you might be thinking, well, that's impossible. If the market's here and I bought here, I don't know which way the market's going to go. Nobody knows which way the market's going to go. And that's true. But what you can do is you can set exits, and then you are in control of your relationship with the market. If the market's going up, cool, I'm getting out here. If it goes down, cool, I'm getting out here. Like, you kind of don't care where the market goes. The market goes wherever it wants. So no, you don't control it. You don't try to predict the market, but you do control your relationship with the market. And that's the opposite of hodling, which is where you're at the mercy of the market. You wake up every day and Did the market gods smile upon me today? Am I up? Am I down? You don't get to decide. When you start planning your own exits, you get to decide how much money you win and how much money you lose per trade. So I think it makes a huge difference, not just practically, even psychologically, just feeling in control. To leave you with a quote that I like, or a saying, it's don't confuse smooth sailing with good sailors. Good sailors can sail in any weather. If somebody made a bunch of money in a bull market, that doesn't mean they're a good trader. That happens a lot. People make a lot of money, they got some lucky trades, and all of a sudden they think they're a good trader. Good traders can trade in up markets, down markets, flat markets, high volatility, low volatility. That's your job. There's no luck. You don't care what the market's doing. Your job is to figure out your relationship with the market. Your job is to be a good sailor and sail in any weather. So that's it for this video. Thanks for watching. Again, if you have any comments, questions, leave them below or hit me on Twitter, and I'll see you at the next one.